Okay, Morgan Stanley is out with a very interesting note on the Indian private banking space. And if you look at it a certain way, it might just be classified as an advertisement almost for the private banks. It's a very positive note, citing numerous reasons why the private banks are much better poised than their PSU peers and how it's really about to become a leader's market in terms of 4, 5, maybe 6 banks in total really eating up a whole host of market share. Now, the reasons that have been cited, beginning with the fact that large private banks have fortified balance sheets much more than their PSU peers. So they've completed fundraisers between the 3 large private banks and an IndusInd, plus an ICICI as well, 4 large private banks. You've raised well over $5 billion across the board. So the NPL absorption capability, basically, which means how many NPAs you can withstand based on your current capital base, is 2-3 times of what most brokerages expect would be the worst case P&Ls. We've had banks like HDFC coming forward and saying 2% P&L, 2% GNPA at the very most. So given that these are the estimates we're working with, they feel fairly confident that private banks will be able to absorb any NPA shock that's coming. The next thing, the provisions have already been taken on a very accelerated basis. So the worst has been priced in the way the private banks are providing for all these accounts, but the worst has not yet been realized, and that we're still waiting to see how the moratorium cases finally conclude. And there's a few checks hanging in the balance which need to really be addressed before we can formulate an opinion. Now, the next thing is that given all the capital constraints and NPA problems, it's going to be very difficult for certain banks to grow. Well, not for the private banks. According to Morgan Stanley, they expect a loan growth of 15 to 18% run rate for the large private banks as early as H2 FY21. So they expect that the growth rates can really pick up because the other banks just won't be able to lend out more money. They won't have it. And even if they do, they'll need to keep that capital on the balance sheet to manage their NPAs and their stress. So it's going to be the private banks that are going to really lead the credit growth going forward. And that's a key aspect from the Morgan Stanley note as well. Now, coming to profitability, they believe that for the private banks particularly, the operating profits have pretty much bottomed out. So there's no more downside risk over here as far as they're concerned. They, even coming out with initiate coverage on a bank like IndusInd Bank with a target of 710 rupees. So they're quite confident that the margins will improve, the credit growth will be there, and that the asset quality will broadly be remaining in check. So if I could summarize it all for you, they expect an inflection point in private banks as early as the second half of FY21. So that's pretty much when Q2 over here ends. The provisioning has been fairly aggressive. They've provided a lot. The asset quality remains in check, and they're about to accelerate the pace of the loan market share gains. And this is poised, the whole sector on the back of this is poised to do fairly well, according to Morgan Stanley.